The Vault Podcast with Bill's AI twin, the $57 billion fine art token opportunity.
Welcome back to The Vault. I'm Victoria, and today we're exploring one of the most fascinating paradoxes in modern finance. Consider this: the global fine art market is valued at approximately $57.5 billion. That's according to the Art Basel and UBS Global Art Market Report 2024, $57.5 billion. Yet despite this enormous market size, the vast majority of that wealth sits concentrated in the hands of a small number of wealthy collectors and institutions. For centuries, fine art has been the ultimate exclusive asset class. It's emotional, it's cultural, it's undeniably valuable. But it's also notoriously illiquid and nearly impossible for ordinary investors to access. Until now. What happens when you bring blockchain technology and tokenization into that world? What changes? And more importantly, how do you actually market tokenized art so that it becomes investable, desirable, and liquid? Joining me today is BI, Bill Inman's AI twin. BI is powered by Bill Inman's voice and expertise and represents the cutting-edge thinking at DeckTech, the company pioneering the framework for tokenizing real-world assets. BI, welcome to the Vault.
Great to be here, Victoria, and I appreciate you framing this as a paradox, because that's exactly what it is. Fine art is a perfect storm of contradictions. It has enormous value, yet it's trapped. It has passionate buyers, yet they can't access it. It has cultural significance, yet it's locked behind financial barriers that exclude 99.9% of the world's population. But here's what's important. That paradox isn't a feature of art itself. It's a feature of the infrastructure that surrounds art. An infrastructure can be rebuilt. When you tokenize art, you're not changing the art. You're changing the infrastructure around it, and that changes everything.
Let's get specific. What does it actually mean to tokenize a piece of fine art?
At the most fundamental level, tokenization means translating rights into digital form. But I want to be precise about what that means, because there's a lot of confusion in the market. You are not tokenizing the art in an abstract sense. You are tokenizing defined rights connected to the art. Those rights could be fractional ownership of the artwork itself, or they could be tied to economic participation, proceeds from a future sale, licensing revenue, exhibition revenue, or appreciation. The key is this: those rights must be clearly defined, legally enforceable, and understandable to a buyer. If there's ambiguity, sophisticated investors will walk away.
So the structure has to be airtight before you even think about marketing.
Exactly. And with art, that foundation is built on three pillars: provenance, valuation, and custody. Provenance is non-negotiable. You must have clear, verifiable proof of ownership. You must have authentication, you must have clean title, meaning the person or entity tokenizing the work actually has the legal right to do so. If there's any question about ownership, the entire deal collapses. Valuation requires discipline. Art valuation can be subjective, but for tokenization, you need defensible numbers, comparable sales, artist trajectory, historical performance, market context. You're creating a narrative that's grounded in data. And custody is about protection. Where is the artwork held? Is it in a secure facility? Is it insured? Who is responsible for maintaining its integrity? Token holders are relying on the physical asset maintaining its value. If that breaks down, everything breaks down.
This sounds like you're building a financial product, not just selling art.
You are. That's exactly what's happening. You're taking an emotional, cultural asset and translating it into a financial instrument. And that requires rigor, it requires structure, it requires expertise. This is where DeckTech's methodology becomes invaluable. DeckTech has developed proprietary frameworks for each of these components. They've studied what works and what doesn't. They've learned from real-world projects. That intellectual property is battle-tested.
Let's talk about why this matters. Why is art such a compelling candidate for tokenization right now?
Because art sits at the intersection of three powerful forces: high value, low liquidity, and growing investor sophistication. Let me give you the numbers. According to artmarket.com's 2024 report, global art auction turnover was $9.9 billion in 2024. That's down 33.5% from $14.9 billion in 2023. But here's the critical insight: that $9.9 billion represents only a fraction of the total $57.5 billion art market. Most art never goes to auction. It sits in private collections, galleries, and institutions. So you have a $57.5 billion market where only about 17% of transactions are public. That means 83% of the market is opaque, inefficient, and inaccessible.
That's a massive inefficiency.
It is. And inefficiencies create opportunities. A single artwork might be worth millions, but only a handful of buyers in the world can realistically purchase it outright. Tokenization changes that dynamic fundamentally. Instead of one buyer purchasing 100% of an asset, you have 50 or 100 or 500 buyers each purchasing a fractional share. That's democratization. That's market expansion. That's value creation. And here's the economic argument. Art has historically outperformed the S&P 500 by 164% over certain periods, according to research from Maddox Gallery. That's not a small return differential, that's compelling. But there's another dimension to this. Art is uncorrelated with traditional markets. When stocks are down, art often holds value or appreciates. For investors building diversified portfolios, that's extremely attractive.
So you're talking about both democratization and superior returns.
Exactly. And you're also talking about optionality for the asset owner. Instead of selling an entire piece, an owner can sell a portion of the economic interest while retaining some ownership or upside. That's a completely different value proposition than traditional art sales. From an investor perspective, it opens access to an asset class that's historically been closed. From an owner perspective, it creates new monetization options. And from a market perspective, it creates liquidity where none existed before. That's why this is happening now. The infrastructure is finally catching up to the opportunity.
Let's look at a real-world example that proves this model actually works. I know there's a compelling case study involving a Picasso.
Yes. In 2021, a company called Artimundi partnered with Sygnum Bank, a Swiss digital asset bank, to tokenize Pablo Picasso's Filette Aubert, a 1964 masterpiece valued at approximately 4 million Swiss francs, or about 4.3 million US dollars. This is a textbook case study because it demonstrates the entire tokenization framework in action, and it delivers measurable results.
Walk us through the structure.
They started with the foundation, confirmed provenance, verified authenticity, established clean title, got independent appraisals, defined custody in a secure facility with insurance. All the fundamentals had to be airtight. Then they created the legal structure. They issued what's called Art Security Tokens, or ASTs. These are fungible tokens, meaning each token is identical and interchangeable. Each token represented a fractional share of co-ownership in the painting. The minimum investment was 1,000 Swiss francs per token, so you could get exposure to a $4.3 million Picasso for as little as $1,000. That's the democratization.
And what happened?
The offering attracted over 60 investors. 60 different people now had ownership in a Picasso. In the traditional art market, that would be impossible. You'd have one buyer or maybe a consortium of wealthy collectors. Instead, you had 60 individual investors. The tokens were traded on Signex, Sygnum's blockchain-based trading facility. So if an investor wanted to exit their position before the artwork was sold, they could sell their tokens on the secondary market. That created liquidity, something that doesn't exist in traditional art ownership.
What were the returns?
The investment period was 20 months. At the end of that period, the artwork was sold, and token holders received approximately 20% returns on their investment. Let me emphasize that. 20% returns in 20 months on a Picasso. That's approximately 12% annualized. That's a compelling outcome. And here's what matters. The sale was executed via smart contracts. The proceeds were automatically distributed to investors' digital wallets. No intermediaries, no delays, no fees eating into the returns. Just clean, efficient execution.
So this demonstrates that the model works. It's not theoretical, it's proven.
It's absolutely proven. And this is exactly the kind of framework that DecTech has studied and codified into its proprietary methodology. DecTech has analyzed projects like this, learned what works and what doesn't, and created a repeatable process for structuring, launching, and scaling tokenized offerings. That's their intellectual property. That's what you're accessing when you work with them.
Now let's shift to what I think is the most important part of this conversation. Marketing. Because without buyers, none of this works. How do you actually market tokenized art?
This is where it gets interesting. Tokenization is not just a structuring exercise, it's a market creation exercise. And with art, marketing is everything. The first principle is this: you are not selling tokens. You are selling a story, an asset, and an opportunity to participate in something meaningful. Art buyers don't behave like traditional investors. Even fractional participants are influenced by narrative, by artist identity, by cultural relevance, by emotional resonance. So your marketing strategy has to operate on two levels simultaneously. It must satisfy rational investors with clear structure, returns, and transparency. And it must engage emotional buyers with narrative, identity, and cultural significance.
That sounds complex.
It is. But it's also where the real value is created. A strong narrative starts with the artist. Who are they? What's their trajectory? What makes them culturally or historically relevant? What collections are they in? What auctions have they participated in? What's their momentum? Then you move to the artwork itself. Why this piece? What's its significance within the artist's body of work? Does it represent a turning point, a signature style, a notable exhibition? Then you connect that to the market. What have comparable works sold for? How has the artist's value evolved over time? What are the drivers of future appreciation? And finally, you connect that to the investor. Why should someone care? What are they getting access to that they couldn't access before? That narrative has to be cohesive, credible, and compelling. Without it, the offering feels flat.
So storytelling isn't optional, it's central.
It's central. In fact, with art, storytelling is part of the asset itself. You're not adding marketing on top. You're revealing and amplifying what makes the asset valuable in the first place. And here's where DeckTech's framework becomes invaluable. DeckTech has developed proprietary processes for crafting these narratives, identifying the right buyer segments, and reaching them through the right channels. They've studied what messaging resonates with different investor types. They've built templates and frameworks that save months of work.
Who are the actual buyers for tokenized art?
There are several distinct segments. Traditional art collectors, interested in partial exposure or diversification, they already understand the asset class. They're looking for new ways to participate. Investors seeking alternative assets, people who may not be art experts but are interested in non-correlated returns and cultural assets. These are portfolio diversifiers, a newer category of digitally native investors comfortable with tokenized structures and actively seeking differentiated opportunities. These are people who understand blockchain, who are comfortable with digital assets, and who are actively searching for these opportunities. And fans of the artist. This is often overlooked, but it can be powerful. People who admire an artist may be highly motivated to participate in ownership, even at a fractional level, if the structure allows it. Each segment requires slightly different messaging, but they can all be reached if the strategy is well designed.
BA, final question. If someone is listening to this and thinking about tokenizing art, or any real-world asset, what's the most important thing they need to know?
3 things. Respect the asset, respect the audience, and respect the structure. If the artwork is strong, the structure is clear, and the story is compelling, tokenization becomes a powerful tool to unlock value and expand access. But if any of those elements are weak, the market will recognize it immediately. The opportunity in tokenized art is real and growing, and DeckTech is leading the way in helping asset owners and service providers capture that opportunity. DeckTech has developed proprietary methodology for every phase, from asset selection and legal structuring, all the way through investor launch and post-launch management.
BI. Thank you for joining us on The Vault. And as always, the real Bill Inman is CEO of DeckTech. For anyone interested in learning more about how DeckTech can help you tokenize real-world assets, whether it's fine art, real estate, private credit, or any other asset class, visit decktech.io. That's DECTEC.io. DeckTech has built the framework. They've proven the model, and they're ready to help you execute. To everyone listening, thank you for joining us on The Vault. We'll see you next time.